Hello, everyone. Thank you for joining us today, and welcome to this educational presentation of how to catch a runaway market. Now, other than the last couple of days where we've experienced some downside move here in the markets, the stock market, all the indices, and a lot of the stocks we trade, and also futures as well as currency pairs, have been in just basically straight up directional market. Now, this doesn't mean that it can go and change directions, and oftentimes we find ourselves in these markets that just are called runaway markets, where they just keep on going and going and going. Many times you may be in them already and then exit too early and then see them continue to move on and on. So we've seen this as of late. For example, if we look at this stock, MAR, we see here that this is a runaway market to the upside coming into this last week here in January. Now, let's say even perhaps that you purchased it here and then exited just after taking a couple of points profit, maybe with options or whatever. Well, I'm going to show you a technique today, an entry technique, where you could have gotten back into the market and captured these runaway markets by entering here, 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 and even later on, such as here and even here. So this is a technique you'll learn today. You'll know all the basic rules for this. It's extremely simple, but very powerful way in which to capture and re-enter into runaway markets. So this promises to be a great presentation. Welcome once again. My name is Steven Primo. I am the president and founder of Specialist Trading. I teamed up about 8 years ago with Pro Trader Strategies, where we formalized this educational process, where all we do is educate our members around the world in over 110 countries and in virtually every state in the United States. And the reason why we're so focused on educating you is we feel that's the one thing that's missing with most traders. Most traders rely on someone or something else to tell them how to trade. And that, we feel, is the reason why it's been estimated that upwards of 80% of all traders fail. It's because you're relying on someone or something else to tell you what to do, and you're not making your own trading decisions. Now, the reason why most traders don't do that is because we've never been taught how to do that. We haven't been entrusted with sound fundamental education that stood the test of time. So that's what our goal is, simply to give you fundamental education that has stood the test of time, things that have shown to have high levels of consistency in them, and then mentor you along the way so that you can ultimately be in charge of your own trading destiny. That way you'll become a consistent trader. Now, I say this because I fell into the same trap when I first started trading some 41 years ago. I did the same thing that just about all of you have gone through. I was listening to other people say what they thought you should buy or sell. I was, we didn't have chat rooms or trading rooms then, but we had newsletters, and I was doing everything that they said in the newsletter. I was watching all the trading gurus on TV, even though we didn't have the internet back then. And I had tons of indicators that were supposed to tell me when the markets were going up or down. And lastly, I listened to every bit of news information there was to help me decide what to do. So all my decisions were based on these outside sources. But I wasn't basing my decision off the one thing that I should have been, and that was the market in front of me, what I was trading. So that's what we do at Specialist Trading. I've been trading for 41 years now. I started my trading on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years. 9 of those years I was a specialist. That's where we get the name Specialist Trading. A specialist simply made markets in roughly about 50 or 60 stocks. So I did that during the crash of '87 and the bull market that followed. After I left the floor in the mid-90s, I managed money. I traded my own account. And as I stated earlier, I formalized Specialist Trading with Pro Trader Strategies about 8 years ago, where all we do is educate our members around the world. Okay, so I've seen and traded just about every market system you can think of. I've been in every market environment you can think of. So I know what works in terms of consistency, and I know what doesn't. Now, the good news is I have a very consistent technique I want to share with you today for capturing these very strong trendy markets and runaway markets. But before we do, as always, we're first required to show you our disclaimer. So please take a moment to view it. I'm going to show you a lot of performance results using this particular technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Remember, we are an educational company, so all examples are strictly for educational purposes only. So as you're taking a brief moment to view our required disclaimer, I would also like to take this time to invite each and every one of you to follow us on Twitter. There's our handle right there. You may want to copy that down, abbreviation for Specialist Trading. I post different information on a daily basis, anywhere from signals that our strategies have generated to indicators telling the proprietary indicators we have for trend directional tools to little bits of wisdom along the way. So lots of great information. Feel free to follow us on Twitter. Okay, so as I stated in the very opening sentence, we are a little bit different from most companies in that our main focus, in fact, our only focus, is on educating you as a trader. This is what's keeping you from your success, from your consistency. It's not the perfect $10,000 trading system. It's not the perfect guru in a trading room that tells you what to do. It's your education that is keeping you from your success. So this is what we're trying to provide you with. Our only goal is simply to teach you, not to force feed you signals, not to tell you the perfect market or the perfect time frame, but to teach you how to trade with the specialist edge. This is the same edge that turned my trading around when I was struggling some 41 years ago. Hopefully it'll be the same edge that can turn your trading around as well. Okay? Now, since we are an educational company, we take questions all the time, but please hold off till the very end of today's class to ask any questions. We have a good crowd here today, and we're unlike a lot of other webinars where we stop for every slide. If we do that, we'll be here a good portion of the day, and I don't want to take the rest of your afternoon when you could be focusing on learning what I'm going to be sharing with you today. So if you have any questions, kindly wait till the very end of today's class. Now, the only question I will answer is the most common one: is this being recorded? Yes, it is. So if you have to leave early, or if you have to, if you're having technical difficulties where you can't see or hear the screen, many times if you log off and then log back on, everything will be corrected. But if you're still having technical difficulties, Pro Trader Strategies will send you a link to this recording. Okay, so not to worry, we are recording this. Okay, so thank you once again. If you joined us late, kindly wait till the end to ask any questions. All right, so here are the tools required for this technique. Remember, we're trying to capture those runaway markets. Well, firstly, we need a runaway up or down trend. And that's very easy to see because usually it's after the fact. In other words, these are markets where you just look and you say, boy, I wish I had gotten in this, but it's too late now. I don't know where to get in. Or maybe you were already in and you got out too early. So they're not very difficult to see and difficult to identify. These are markets that are either going straight up or straight down, or have a nice upward bias or a downward bias. And then once we have identified that, then we simply need to apply a candlestick engulfing pattern. This is the best pattern I know of candlesticks for capturing those runaway markets, because it will generate setups all along the way in a runaway uptrend or a runaway downtrend. Okay, now for those of you who are not familiar with engulfing patterns, let's give you a brief refresher course. Excuse me. An engulfing pattern is a two-bar pattern, as you can see here, bars number 1 and bar number 2. Makes no difference if we're looking at a 5-minute time frame, a monthly, a weekly, or daily. It makes no difference. It's going to be two-bar pattern. All right. Now, a bullish engulfing pattern has a bullish bias, obviously. Now, bar number 1 is usually a down day. So the open to close level is, in other words, the close is lower than the open, and that's where we have this dark body right here on the left. Now, bar number 2 is usually a higher or up day. So we open and then close higher. What we're looking for is bar number 2's open to close range to totally engulf bar number 1's open to close range. But all we're interested in is engulfing the open to close ranges. We do not need to engulf the entire bar. Now, if we do engulf that, that's fine. But all we need as a requirement is to engulf bar number 1's open to close range. If we have this in place, usually we have an upward bias. Now, conversely, a bearish engulfing pattern is just the same thing, just flipped upside down. It's a same two-bar pattern in any time frame, but bar number 1's open to close range is higher. In other words, we open and close higher. Bar number 2's open to close range is lower, where we open and close lower, as represented by the dark body. Now, all we need to engulf is for bar number 2's open to close lower range to engulf bar number 1's open to close range. Okay, that's all we need. When we have this in place, this usually has a negative bias, okay, meaning that we will go lower. Now, here's the way traditional wisdom has told us to trade these. The engulfing candlestick pattern is a reversal pattern. Now, conventional wisdom says to trade them at the top or bottom of a trend. So if you see the market going higher and higher on these runaway upward moves, the entire time we're going higher, you're looking for a bearish engulfing pattern. That is a reversal, okay? Conversely, if you see the market going lower and lower and lower and lower, what you're looking for is a bullish engulfing pattern, a reversal to the bottom, creating some type of bottom so that we will go back up. This is the way conventional wisdom, and this is the traditional use of these engulfing patterns. There's only one problem. There's not that much consistency when we trade it that way. Take it from someone who was taught this 41 years ago. I used to trade the candlestick patterns, and they would work pretty good every once in a while, but every once in a while when they didn't work, I'd give everything back. So I discovered through my mentors an even better way to trade engulfing patterns. Engulfing patterns will have a higher level of consistency if you trade them in sync with the trend. So rather than trying to pick a top or a bottom, a reversal, forget that. Just trade them in sync with the trend. So if we have a runaway market that's going to the upside, you're looking obviously for a bullish engulfing pattern. If you have a runaway market to the downside, you're not looking for a bottom, you're looking for a bearish engulfing pattern because the trend will continue. It's like this strong river that's going in a certain direction. You're not going to look for it to change course and all of a sudden stop and go the other direction. You're going to look for it to jump in the water so you can go downstream with the current at your back because it's going to continue in that direction. Okay? It's the same way with trading. We're not going to try and find any time or place when these runaway markets will stop, because it's like standing in front of a speeding train. It may work every once in a while, but the time it doesn't, you'll give everything back and you'll get run over. So there's no consistency in that type of trading. So let me show you how this works. Obviously, we have a runaway market to the upside, as we see here in hindsight. Conventional wisdom would tell us to look for a top, so we're waiting for a bearish engulfing pattern. But there's no consistency in that. So what are we going to look for? We're looking for a bullish engulfing pattern. We're going with the river. We want the current at our back. And so if we look at all the bullish engulfing patterns here, we see that there was one right here. You see it's a 2-bar pattern, and bar number 2's engulf, open and close range engulfed bar number 1's. We have another one right here, 2-bar pattern. Bar number 1 is down, bar number 2's open to close range engulfs that. We have another one right here, 2-bar pattern. Bar number 2's open to close range engulfs bar number 1's. We have another one here, and you see how you have this consistency because you're in sync with what the market wants to do. You are no longer trying to fight it. You're not standing in front of a speeding train, putting your hand up and saying, you will stop right here. I mean, that is really silly and egotistical to think we know how and when a market will stop. It's a lot easier just to go with it as opposed to trying to say when it will end. And the same thing can work to the downside. Now, obviously, this is not as strong as a downward move, but we still have a downward move here. And most likely, if you were trading engulfing patterns, you would use them to find a bottom. But there's no consistency in that. Why don't we just try to go with the downward runaway market? So we're looking for bearish engulfing patterns. There's one right there. Bar number 2's open to close downward range engulfs bar number 1's range. And then there's another one right here. Now, so far, it's working out okay. It's not going down tremendously, but usually it will kick in if you have a strong enough runaway market. Now, there's one last signal we had right here, and then look what ultimately happened, okay? So trying to pick a bottom here would have, reaped disastrous results. Remember, the best thing is to go with the flow as opposed to trying and predict when a market will stop going higher or when it will stop going lower. That is a recipe for disaster, and that's probably what's keeping you from your success. So that is the basic premise of today's educational presentation. Let's show you a lot more examples in different markets, different time frames, so that you can understand this concept and you can start to see once this concludes today and go and do your own research, and you can say to yourself, wow, I've been doing this all wrong. This really does work. I've left so much money and so much consistency on the table by trying to use candlestick patterns as a reversal pattern, all right? And these are all going to be fairly recent charts coming into this last month. As we see here, ABBV was having a nice slow uptrend, nothing great, but let's just say perhaps you bought it down here on this breakout and sold it up here, and you say, boy, I have a great trade, but it continues to go higher in November, December, and into January of this last month. Well, we had two engulfing patterns along the way that could have gotten you back in, and ultimately, look what happened. Had you taken that very first setup, that would have generated 30 points to the upside that you could potentially work with. Now remember, we're not telling you where to exit in this presentation. We're not telling you where to place your stop. We're not telling you how to track the trade. That comes in our courses. What we're trying to do today is just share with you a great technique for spotting these high probability entry areas. And then how you want to enter, where you want to place your stop is up to you at this point. But wouldn't you like to have this edge in your favor right now? Let's look at Netflix, okay? This was just a couple of weeks ago and the second week of January. We see here that the stock had been going up rather sharply. Now, most people have said, well, I don't want to get in this anymore. It's already gone up way too much. I can't buy up around here, but you have a bullish engulfing pattern right here, okay? Now, by the way, if you see those little green arrows under there, our PTS Primo charting platform, which all these examples have been displayed from, will generate these bullish engulfing patterns, and it will generate a little up arrow below that, just to let you know. So as we circle this right here to show you with clarity where to look what happened later on. This was coming into this past week. 60 points you could have worked with, even after the market had gone up substantially, you still could have gotten in because the market is always telling you what it wants to do. And if the market's going higher, remember, you don't want to look for a top. You want to go with it. You'll have better level of consistency that way. Let's look at GE. Now, GE has been going down in hindsight. If you would have tried to pick a bottom, let's say you would have thought this was a bottom right here where you would have lost money. Let's say on this close, you would have thought, well, now we've really bottomed out, and it has never rallied since. So you would have lost money trying to stand in front of the speeding train to the downside. What if we just went with it? Well, here's a bearish engulfing pattern right here as identified by our platform. And there's another one right here, and even another one later here. So you could have, if you had even taken this one after this strong sell-off, that's still 4 points in your favor. Now the moves to the downside are not as strong because obviously we've been going up for the past year. So things, we don't have a lot of really strong examples to the downside, but that's okay because you can see it will still work. Here's ABC coming into January. Very strong, upward moving runaway market. Too late to get in, right? It's already had its move. Well, we see here's a bullish engulfing pattern right here. But once again, someone would say, well, Steve, here's a bearish engulfing pattern. Don't I want to use this for a reversal? Well, how well did this work? If you had used this bearish engulfing pattern, did we really go down? Why not just go with the flow and stay in sync with the current trend, and you could have had 10 points potentially to work with to the upside. How about AME? Another strong runaway market to the upside. Most people would say, well, gosh, I can't get back into this. This is ridiculous. It just keeps going higher and higher and higher. The stock was trading at roughly 60. Now it's touching roughly the 80s. How can I get into this? Well, look at all the buy setups that a bullish engulfing pattern was generating all along the way up. Okay? So this is what we mean by consistency. When you ride the coattails, not of some guy in a trading room, or not of some guy on TV, or not of some master indicator, but you ride the coattails of the market, you'll have a higher level of consistency than trying to ride the coattails of this traditional wisdom that really shows no consistency. All right, let's look at letter D. All right, now this has been going down. Someone would say, well, Steve, we got really major support here. This is where all the institutions are buying. It looks like we're making a double bottom. I can't sell here. Well, what's the market telling you? It's giving you a bearish engulfing pattern. Bar number 2's open to close range is engulfing bar number 1's range. So that's a clear setup to sell. Now, we're not telling you exactly where to sell. Remember, I know that'll probably be your number one question, or where do I place my stop, or where do I exit? That's in our courses. We're just giving you education today on how to identify these high probability setups. But look at that. Had you taken that, 6 points to the downside, okay? And if you missed that, well, there was another one later on. That's the beauty of these strong runaway markets. If you miss one setup, if the trend is strong enough, regardless of the direction, you usually get multiple setups. How about XL? Another move to the downside, strong move, all right? There was a sell setup there, another one here, and so on. Had you taken the very first setup, 7 points in your favor coming into January. Now, this is the same time the market, other stocks have been going straight up. Well, this individual stock was going straight down. How about VLO? All right, this used to be my nightmare because why? Because I was trained, once this thing starts going up, you've got to sell it. It's overbought, right? All the indicators are telling you it's overbought. Plus, this guy on a newsletter I subscribed to said it was gone way up too high. You got to sell it. And all the institutions were probably selling along the way, and all the Fibonacci resistance was being met, and all the Elliott wave resistance. Okay, remember, look at how I'm defining what is supposed to be telling me what to do. They're all outside sources telling me what they think of the market. Why not just look at the market itself? The market is telling me right here off of this snapshot that it wants to go higher. So why don't I just go with it? How do I apply some structure? In the form of a bullish engulfing pattern. There's one right there, another one here, and if the trend is strong enough, if the runaway market is strong enough, you'll get multiple setups all along the way. Had you taken the very first one, even after you had this nice rally, that would have been 25 potential points to the upside to work with, to capture. How about JBHT? This is coming into this last week as well. $100 stock going straight up. There's no way you should be buying this, right? Here's a bearish engulfing pattern. Here's another one. Here's another one right here. Let's see. Here's one. And all along the way, bearish engulfing patterns were generated, and the stock kept going higher. Remember, if the stock is going higher, we're not looking for a reversal. That is a recipe for disaster. That's a gambler's mentality. What we're looking for is simply to go with it. And we have to apply some structure. What's our structure? The bullish engulfing pattern. Because the market is going in a bullish upward move, well, then we'll go with it and look for bullish engulfing patterns. And look at all the nice areas you could have had to initiate a trade. Starting with the first one, that would have been 15 points to the upside you could have worked with. Now, let's look at an entirely different market, different time frame. Let's start out with a daily chart of the E-mini futures. Now, look at all the setups you had here to go along. Now, this is coming in from September, October into this last week before we had the sell-off yesterday, okay? Now, that's 340 points. That's roughly about $17,000 per contract if you had just taken this very first setup. Now, I'm not telling you that you would have made $17,000. Okay, but that's how much you had to work with per contract. Sure, you could have gotten in and gotten out with a 1-point gain or $50. It's up to you. You're in charge of your own trading destiny. Remember I said at the very beginning, our job is not to tell you where to buy, where to exit, where to place your stop. Our job is just to supply you with that information, all the different variables, work with you, mentor you, and then let you decide on the exit, on the entry pattern, on the stop placement that makes you feel the most comfortable. Remember, we're an educational company providing you this service of education. How you decide to use that education through our mentoring and through our courses is up to you. But we're giving you high probability information so that you can be in charge of your own trading for the first time. Now let's go to a different time frame, 10-minute time frame, okay? Here's a 10-minute time frame. This was January 24th. The market's going lower. All right, someone saying here was, well, you know, gosh, I'm watching this guy on TV. He's telling me we're at this major support in the E-mini. I've got to buy here, okay? We made a double bottom. Which way is the market going? It's going lower. We're not going to try and pick a bottom, all right? And also, there's a bearish engulfing pattern here. Look what happened in the next 20 minutes to half an hour. An extra 10 points to the downside, all right? That's $500 per contract that you could have potentially been able to work with. And once again, and even another signal was generated in the next 10 minutes as well. Let's look at the Forex markets. We know we have a lot of Forex traders out there. Here's an Australian dollar. Obviously, this is from December all the way into this January, this last week. We've been going straight up. All right. Anyone who has lost money only because they've been trying to sell it, because the market has been going straight up in the Australian dollar. So why would you stand in front of this train that's going straight up? Why not go with it? How do we go with it? Well, with one of the many techniques we teach you, we're teaching you today about the bullish engulfing pattern. There's 1, 2, 3 all along the way. Had you taken the very first one, that's 400 pips you had potentially to work with in your favor. Now, how about the Swiss franc? Well, this has been going lower, right? Well, someone would say, well, Steve, here's a bullish engulfing pattern right here. Boy, we got to buy here. Well, if that works so well, why didn't this bullish engulfing pattern work? It went up maybe for 3 or 4 days and went lower. The reason is because there's no consistency in using candlestick patterns as a reversal pattern. You'll have a higher level of consistency if you trade candlestick patterns, most especially engulfing patterns, in sync with the current trend. So what is the trend? It's down. So are we going to be trying to look for bullish engulfing patterns? No, we're going to be in sync with the market and trade and identify bearish engulfing patterns. And there was one right here, even after we had gone down a lot on the Swiss franc, we still could have in 3 days generated a 275 pip gain, or close to $3,000 per unit, okay? All right, so ask yourself, do you think this technique could have helped your trading this past year? What if even if you don't use candlesticks, even if you don't use bullish or bearish engulfing patterns, what if you could just say to yourself, well, you know what? Maybe I have been trying to stand in front of this train, for too long. Maybe I have been trying to swim upstream too much. Maybe that's why I've been unsuccessful for the last 5 years. Maybe if it'd be a lot easier if I just simply went with the flow of the market. That's one of the main things we try to instill in all of our students around the world, is that the market is your best friend. It's continually trying to tell you what it wants to do. And all our job is as a trader is to listen to what it wants to do and then jump on board. Here's the only trouble. Here's the way we're always taught. This indicator is what you should listen to. Or this trading guru in this chat room or trading room is what you should listen to. Or this guy on TV is who you should listen to. Or this economic report that's supposed to come out is what you should listen to. That's the way we're all taught and trained, myself included. But trust me, I was using those same categories and those same features, 41 years ago? And they didn't work then, so what makes you think that they're going to work now? There are a few traders who are able to use those things on a consistent basis, but the majority of traders, myself included, have a very difficult time making them work for us. And if they did work so well, then why has it been estimated that upwards of 80% of all traders fail? And when I say fail, I don't mean that you're going to have a bad couple of months or a bad 6 months. Failing means you lose all the money you've set aside for trading. Shouldn't it be the other way around? Well, maybe it's because you're not listening to the one thing, which is the market. Well, that's what we do at Specialist Trading and Pro Trader Strategies. We teach you how to listen to the market and then give you structure so that you can trade in sync with the market. So here are important points to remember about what I taught you today. This is not a complete strategy. I know once I go into the question and answers in the next 10 minutes or so, a lot of you, the first question is going to be, Steve, where do I put my stop? Or where do I place my exit? Or where do I enter exactly? Remember, those are all pieces of the puzzle to a strategy. If you recall, everything I gave you today was a technique for identifying a high probability setup. So remember, we didn't talk about advanced entry signals, and we provide these in the courses. We give you many different ways in which to enter. We didn't talk about stop placement. Most of our courses and strategies come with upwards of 6 different places to plot your stops. We also didn't talk about exits. There are a number of ways in which to exit for higher risk reward ratios, to get in the market quick or stay in as long as possible. And then lastly, we didn't talk about money management. How many shares should you have traded? How many lots? How many futures contracts? We didn't talk about any of that. These are all important things that one needs in order to actually trade. We can't just say, well, that's a high probability entry. Okay, well, now what do we do? You need the structure, you need the mentoring, the education on where to get in, where to place your stop, where to exit. All right? Now, here's the good news. We have a great discount today using a strategy based off of the same features we talked about today. This is Primo strategy number 5. All right? This is our attendee special. This is the best candlestick course we have, and it's specifically designed to catch those runaway markets. Okay? You're going to get instant course access, detailed instruction, 10 videos. So it's an online course. And in the course, we teach you all about the entries, all about the exits, all about stop placement. All right? Now you can apply this for daily and intraday or even swing trading if you're a monthly bar trader. It makes no difference. This strategy can be applied to all those markets. Okay? Now, we're not going to just stop there. We're also going to throw in our roadmap for any market. This is our pet D. Now, I didn't spend a lot of time on it today because we talk about it a lot in our presentations, but you've heard me speak about it. This is probably one of our most powerful proprietary tools we have at Specialist Trading. Why? Because in my 41 years of trading, it identifies the trend better than anything I've ever used in my life, in my career. And I use it on a daily basis. I was using it before we started the presentation today when I was personally trading the E-mini. I was using it trading the E-mini this morning. Now this is our roadmap for any market. It's a proprietary color bar algorithm that changes the colors of the bars. If the bars are colored green, that means you're in a short-term uptrend. If the bars are colored red, it means you're in a short-term downtrend. Let me show you some examples here. For example, in this chart in Aetna, most people would say, okay, well, we're in an uptrend now, but by the time they figure it out, or by the time their indicator or whatever they're looking at tells them that you're in an uptrend, it's usually around right here, okay? Wouldn't you have liked to know that you're in an uptrend down here? Now, by the time you find out, it's about this level up here. So let's say you like this stock, you decide to get in, and then look what happens. Wouldn't you have liked to known that maybe around here that it's not going to go any higher, that you're now in a downtrend? Well, all you have to do is apply the PET D, and you can see how it automatically changes the colors of the bar. So we don't have to wait to find out if we're in an uptrend. Many times you will know at the beginning of a trend that you are starting to go in one direction, as we started up here. And even though it's not designed to pick the tops and the bottoms, because nothing can do that perfectly, it's the best tool I know of for really spotting in advance many times the change in a trend. As you can see here, right at these levels, it was telling you we are now in a downtrend. You could have exited your position and gotten out a lot quicker than having to ride it all the way to the bottom. Now let me show you how you can use this with engulfing patterns, okay? This is what we call our candlestick combo. If you get that bullish engulfing pattern when you're in sync with an uptrend, a runaway upward market, okay? A way in which to add more consistency to your trading is to apply the PET D. And this means you're only going to buy if the engulfing bar or bar number 2 is colored green. So as we see here, here's our 2-bar pattern. Bar number 2's range engulfs bar number 1's open and close range. And what you want to see here is bar number 2 colored green. Now we have the outline green. That's all that's needed. So if we look at this stock here, this is not a runaway market win. We're basically going sideways. This is how the PET D can help you. Because let's say we go into a sideways market. We've had this tremendous run for the last year where we've been going straight up, but let's say it ends, and it doesn't mean we go straight down, but just all of a sudden nothing happens. The roaring river now just turns into a pond. So how can we trade? This is where the PET D can help us. We have a bullish engulfing pattern right here, but it's not a runaway market. We're just going sideways. How can the PET D help us? Well, we apply the PET D, even though it looks as if there's no trend or range in the market. We see here that bar number 2 is colored green. So that's all we need to confirm that this is an okay setup. And look what happened. Stock went up 12 points in 1 week. So even though we now know how to trade these runaway markets, when you don't have a runaway market, when you have a sideways market, the PET D can really help you confirm whether that engulfing pattern or any candlestick pattern should be taken. Now the same thing happens with bearish engulfing patterns. Sure, if we have a straight down market, if we get a crash going the way we had yesterday, sustaining for the next couple of months, it'll be easy to see that everything's in a downtrend. But let's say the market just goes into like a summer range where nothing happens. Well, you can still trade with the PET D. Using the engulfing pattern, you're only going to sell if bar number 2 in that engulfing pattern is colored red. So we don't care what the color is of bar number 1, just as long as bar number 2 is red. So here's our 2-bar bearish engulfing pattern. We apply the PET D, and we see here that bar number 2 is colored red. This is what we're looking for. So now this is a downward move in the market. If we apply the PET D, we see here that it was telling us well in advance by these first 3 bars telling us that we were going lower. See how the PET D can tell you in advance many times of what the trend will be? And so we already know that we should be going short. Now, traditional wisdom would tell us that, well, but Steve, we've gone down so much, right? We've got to buy. Here's a bullish engulfing pattern. Look at the color of the bars. They're both red. Engulfing bar number 2 is red. So you would never take that trade. And it was a good thing you didn't, all right? So what trade should you have been taking? Well, since the bars are red, you're looking for a bearish engulfing pattern. You could have gotten short here and then again down here. you see how the pet D can help you be in sync with the trend and also confirm your candlestick trades? Here's another example on RTN. Okay, the stock has gone straight up. At this point, most people are saying, well, Steve, you got to look to sell, right? The oscillators are so overbought. The guy conducting the trading room is telling me this is too high, you've got to sell it. But what's the pet D telling you, which is simply translating what the market wants to do? It's telling you it wants to go higher because the trend is up. And who are we to stand in front of a trend? So there's a bullish engulfing pattern. Bar number 2 is colored green. And the stock went up 17 more points after that. See how easy it is when you are in sync with the trend, and the pet D can help you get in sync with the trend. Now, if you missed that first setup, not to worry, there was a second one here, and you could have still captured about 15 more points or so. Now, here's the last example here in CMG. Once again, it looks like a rangy market. In fact, it looks like we've just made a bottom here, maybe a double bottom. We're in a range here. Maybe a lot of the indicators are bottoming out. Maybe there is some guy on TV telling you to buy the stock. But what are the majority color of the bars here? They're red. We only have a couple of green. And what do we have here? We have a bearish engulfing pattern, and bar number 2 is colored red. So what's the pet D telling us? It's telling us that even though you may be in a rangy sideways market, this is a confirmation to go short based on this bearish engulfing pattern. So you don't need to have a runaway up or a runaway down market to take advantage of this 180 point move to the downside. Wouldn't you have liked to have seen that in advance? Now, we had no idea the stock was going to go this low, and I in no way am saying that you would have made 180 points, but you potentially had 180 points to work with in your favor. Why? Because you weren't trying to fight the trend. You weren't standing in front of a speeding train saying, well, this will not go down any further. It has met major support. All the institutions are buying. The volume to the upside is picking up. Do you see how I'm basing this once again on outside sources? What is the chart in front of you telling you? It's telling you, based on the color of the red bars, that it wants to go lower. So why fight that? Just go with it. So if you missed that very first setup, that's okay. There was another one right here, and then another one here, 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 and here, all the way down. A lot easier to make money when you follow the two-step process as a trader. Step number 1 is listen to what the market is doing, what it wants to do. How do we do that? By applying the pet D. It tells us, it translates what the market wants to do. If the colors are green, it's saying the market wants to go up. If the colors are red, it's saying the market wants to go down. And then we jump on board. But we can't just buy at the market. We have to have some structure, some high probability entry points. That's what strategy number 5 does for you. Now, a lot of people say, well, will this work in the face of news? Well, remember, news can happen anytime, anywhere. There's no way to possibly predict it, and there's no way to guarantee that you will be in sync with the news, on the right side of the news. So a lot of people are frightened to trade prior to a news event, or they're frightened to take large positions thinking that, well, if some news comes out, I know I'll be on the wrong side. It's been my experience with the tools we teach that are based on consistency and based on what the market wants to do, is that the market oftentimes tells you in advance prior to a news event. So oftentimes, though not guaranteed, but oftentimes you'll be on the right side of the market before a news announcement comes out. For example, Yahoo reported that Walt Disney buys Murdoch's Fox for $52 billion. This was on the 12th of December, a little over a month ago, okay? So here's the stock, and as you can see, it was going up in advance, but here's when the news came out. Now, most people, once again, base their trading decisions off of news. They figure, well, when that news comes out, well, that's got to be good. If they're getting bought out, it's going to go higher, and that means there's a lot of money being brought into the company, so that's my signal to buy, okay? But look what happened way back here, months in advance. There was a bullish engulfing pattern, okay? And the market had been going higher. Now, if you had used bearish engulfing patterns like right here, well, you would have had maybe 2 or 3 days of small downward movement, but then you would have lost everything once it went higher. Much better to be in sync with the market. Now, how can we add to our consistency more? How can we confirm this and validate this even more? Well, we add the pet D. Remember, we want to see bar number 2 colored green. Once we did that, we see that bar number 2 was green, so this was a valid strategy 5 buy setup. So the stock gained 7 points in 1 month in advance to that news. So that, though it's not guaranteed, it's been my experience in 41 years that what we teach and what we use oftentimes will get you in prior to news events. Okay, now I strongly believe that a year from today, you will have wished you became a member of this course. Look at this past month, how the markets have gone straight up. Other than yesterday and today, we've virtually gone straight up. Wouldn't you have liked to have taken some of these signals using strategy number 5 along with the PET D? I mean, you would have, if I had given this presentation a couple of months ago and you became a member, you would already be reaping the benefits of this course. I strongly believe a year from today, you will have wished you became a member of this course because we're offering you our Candlestick combo. This is strategy number 5 along with the PET D, okay? What comes included with this is mentoring correspondence. You're going to get 41 years of experience of someone who's been trading these strategies and methods as your mentor. So anytime you have a question, you have my personal email address. You'll be able to contact me and ask me any question that you like pertaining to trading of the methods here. Remember, this is an online course. It comes with 20 videos. We share with you all the different ways for exits, entries, and stops. We work with you so that you can decide for yourself how you want to trade it. Do you want to trade conservatively or aggressively? And I know to a lot of you that may seem like out of sync. It's like, well, I thought I'm supposed to be told how to trade. Remember, we've all been taught that, but if that works so well, then why are 80% of all traders failing? It should be the other way around. You should be supplied with information, and then once you learn how each and every one of those pieces of the puzzle work, how you can apply it, then you should decide how you want to apply it to the markets. That's how you become a consistent trader. But we're there with you every step of the way. This is not something you'll have to do alone. Now, this also includes the add-ons. It includes the up and down arrows that will be generated when a strategy number 5 setup is generated, and will also include the add-on for the PET D that you can add on to your platform. So every time there is a green or up bar, it will automatically color it for you. Now, we're giving you this discount. This usually runs close to $4,000. We're giving you now for a one-time fee of $14.95 and $97 per month. Now, if you are not interested in paying a monthly fee, that's okay. We still have a discount on a lifetime for both courses. We're still dropping that about $1,000 down to $29.95. So if you just want to pay one lump sum, $29.95, you're locked in at that deep discount. If you'd like to get a payment plan, $14.95 and then $97 per month. And if you still want to design another type of payment plan, you can contact Pro Trader Strategies. They'll be able to work with you over the phone and construct anything that meets your needs, just so we can get you in the door and have you up and running. Now, here's how to take advantage of this great offer. Contact my sister site, Pro Trader Strategies. You can either email them. My suggestion would be to call them directly at area code 310-598-6677. Now, that link at the very bottom is where you would go to get more information and to sign up for the $29.95 fee, or else for the one-time $14.95 fee plus $97. But that's not a live link, so you have to copy and paste that onto your browser, okay? If you have any trouble, any difficulty, being able to log on to that or emailing Pro Trader Strategies, there's absolutely no obligation. Feel free to call them. They have trading consultants manning the phones right now. They would be happy to answer any question you have. There's no obligation just by calling that you have to purchase anything. They'll answer more questions that you have regarding different platforms and different ways in which to apply this, okay? I'm gonna leave all this information up here, and I wanna thank you for holding off on any questions. I'm going to open up the question and answer box right now. And Joe is asking, can you use Heikin-Ashi charts with this? Heikin-Ashi is for those of you who aren't familiar, it's a different way of looking. They look almost similar to candlesticks, but they have different bars. I personally, Joe, don't trade this, but I trade basically just the standard candlestick bars. I see we have traders who do trade with Heikin-Ashi, and I've never seen any difficulty with them. But to be honest with you, I don't want to overcomplicate things with using one method to complement another. I would basically just stick with standard open, high, low, close bars or candlesticks for our strategies and methods. Because once you use a different way like Heikin-Ashi, which is telling you what the market is doing, and then you have our techniques also telling you what the market is doing, it'll get too complicated. You may get kind of combative signals every once in a while. See, next question is, what's the difference between the PET D fast or slow? Well, just to let you know, we have two different versions with the PET D. One is the standard, which is probably used, I'd say 80-85% of the time, and it's called the PET D standard or PET D fast. And then there's a slower version. Now the difference is that we use the PET D fast for, once again, the majority of all things, and it's based off of trend direction and entries. That's what we use it for. Now, many times, a lot of our students like to stay in the trade as long as possible. They want to get as much bang for their buck out of the trade. So if you get into a trade and you think that it's going to continue higher and higher and higher, we would suggest using the PET D slow, because you can use that as a stop placement type of strategy, type of method. And when the bars change color, you can use that to place your stop, okay? Either above or below that, depending on what side of the market you're on. So that's what we suggest for the different PET Ds. The PET D fast is used for basically for just about everything, for entries and trend direction. We mainly just use the PET D slow if you want to stay in a trade much longer, okay? Fred asks, will this work on Thinkorswim? Yes, it will, but with a few alterations, Fred. First of all, because of the way Thinkorswim is set up, they won't allow us to have our add-ons on their platform. In other words, we can't change the colors of their platform. Not that we don't have the capability, they just don't allow us or anyone else to do that. But they will allow us to use their data feed, okay? And they say it's perfectly admissible, it's okay. So let's say you have Thinkorswim. Even though they won't allow us to run our strategy or our PET D tools on them, what we'll do is we provide you with a free NinjaTrader platform, which we set up for you. And they have allowed us to use their data, so you kind of just split off their data. So it's perfectly okay to be using both platforms at the same time. And the NinjaTrader will generate the up and down buy signals for Strategy 5, as well as the PET D color. Okay. Now, a lot of our students have said since they've gotten this, they've never used NinjaTrader before. They actually even like NinjaTrader even more because it's a lot simpler and a lot more basic. And guess what? You don't have to pay for that. We give you the free NinjaTrader platform, the entire platform for free, and we just simply use the Thinkorswim data to hook up to that. It's all free, and guess what? We have a great tech support department that does that for you automatically. It takes a few minutes. They contact you and they set it up for you on your computer, and then you're up and running, show you how to do that. So it's a great, great offer, and it's no extra charge for this. So if you are a Thinkorswim member, don't worry, because of their restrictions on us, not because we don't want to, because of their restrictions, they won't allow us or anyone else to have their methods on there. So we just use a free NinjaTrader platform, okay? Now, a lot of people are saying, once again, where do I place my stop? Where do I exit? That is all in the course. Remember, we have different places for entries. Let's say you are an aggressive trader. You like to trade, 10 times a day, all right? Well, then we show you our aggressive entry, our standard entry for getting in. Well, let's say you are a more conservative trader and you're more conservative risk-reward ratio, all right? Well, we show you a different way to enter that way, okay? It's entirely different from the aggressive trader. Now you have to decide, what kind of trader are you? Are you aggressive? Are you conservative? And once you decide which type of trader you are, well, then you pick which method works best for you. It's based off the same structure, based off the same candlestick pattern, but we show you where to enter, where to exit. And let's say you're the type of trader that also likes to trade 10 times a day and wants to get in and out quickly. All right, we show you one of our standard exit points. Let's say you're the type of guy who wants to stay in and get as much bang for your buck. We show you another exit point. So you see how this is how you become consistent, by trading what makes you feel comfortable, not by trading some supposedly master trader's plan and what makes him feel comfortable, what made him feel successful. Because even though he may have made $1 million trading this way, you go in there and trade and you don't feel comfortable trading 100 times a day, and you can't do it, and you ultimately will lose money. This is the great myth about trading. No two traders should ever trade alike. You shouldn't ever copy how someone else is trading. You should stick to what makes you feel comfortable. So we provide you with a standard benchmark, a standard format for identifying these setups, but then provide you with different exit points, different entry points, different stop placements. We have upwards of 6 different stop placements to use, and that's how you become a consistent trader. See, Mark is saying, Steve, I am up $6,000 for January, but congratulations, Mark. But the S&P is beating me out of a bit in percentage terms. How do you deal with this? Well, remember, you're not competing with the S&P. You're not competing. I never care about how well someone or something else, whether it's a person or an index, is doing as opposed to what I'm doing. You're only in there for yourself. I don't care if the S&P is up 500% and I'm up 20% for the year. It doesn't matter. All I'm concerned about is trying to get in sync with the market and make myself a better trader, because ultimately, if I do that, the gains will come. I have known traders who have beat the S&P tremendously and done tremendous couple of years, and then guess what? The next year, they give it all back. So if you're in this competing mode of trying to compare yourself with the S&P, it's once again a recipe for disaster. I never cared when I was on the floor what the other traders were doing because I wasn't competing against them. You're not competing or comparing yourself to any benchmark, to any other trader, to any system. All you should be doing is looking at yourself. Look at the mirror and see, are you comfortable with what you're trading? Are you being consistent? Are you following your rules? Okay, that's the only concern I would have. Not really concerned with the S&P. That I could care less. Okay, so that's just, if you're asking me as to how I trade, that's my personal answer. Okay. Remember, don't overcomplicate your trading and don't give yourself these benchmarks that are silly, in my opinion, to focus on. I mean, why would I care? I mean, all you should be caring about is that you're there to trade again another day. That really is all that's important. If the S&P makes 60% one year and you make 2%, that's okay. That's all right. At least you didn't lose any money. Remember, 20% of all traders fail, or I should say 80%. Only 20% of traders make money. So, you don't want to fall in that 80 percentile group. So if you've made 1%, that's okay. That's better than 80% of all other traders. And that will build. It will slowly take time, but it will build. Remember, we're educators. I'm not going to sit here and promise you that you're all going to become millionaires next year. I don't believe in that. And if anyone told you that, I think you should run. What I'm here to promise you is that I will supply you with sound fundamental education that has stood the test of time, that I currently use in my own trading, that has shown high levels of consistency. These are the things that will sustain you. And I think this is what has sustained me to be trading for 41 years. Not some master $10,000 system, not some trading guru I've been listening to for 41 years, and not some news events that I focus on every week that come out. I stopped listening to those things years ago, and I'm still here. So there's no reason why you need to focus on those as well, okay? Now, as an educator, even if you don't decide to become a member of our courses, I really hope you do. But even if you don't, we try to give you something every week in our free webinar series. So I hope you got something out of what you saw today. I hope I taught you something, a different way in which to look at the market as opposed to the way most traders trade. And I hope it can change your trading around. If you just experiment with what I taught you today, I think you will see for yourself that this is the right way to trade, and you owe it to yourself to become a student of our courses. Remember, as I said earlier, a year from today, you will have wished you became a student of ours and a member of this course. So watch this video once you get the link, but don't hesitate. That special won't last long, that attendee discount, and will go up closer to $4,000. Okay, so this is a great offer and a great time to become a student of mine. In closing, I want to say thank you so much for attending. I hope you learned something today, and I look forward to all of you becoming students of mine at Specialist Trading. Thank you so much. I'll see you next time. Bye-bye.